right place. If you've done it before but you need more knowledge about investing, you're also in the right place. So it's good to have you join the call today. It's important that you have your notepads with you, or you probably have your recording device, just so that it doesn't get overwhelming, because there will be lots of information that I'm going to be explaining to you today, so that you don't get your brain juggled up, or you're trying to figure out one and another information is coming. That's the essence of me asking you to get your notepads ready so that you can participate effectively on the call. So the first thing we are going to be looking at is stock investing. And before going into that properly, want to know who investors are. Now, the truth is that we are all investors. And when we hear the word investors, we might want to think of those persons who are working in all these investment firms and all, those persons that are into investment banking. But the truth is that in our little corner, we are all investors. And I'm going to explain that. The business owner is an investor, which we know, but as individuals, in our houses, we are investors. So I'm going to explain that further, because we all need to manage money we make, and we all hope to make more money at the end of the day. Now, when you get paid, probably your salary, or if you're business inclined, when you're into your business, the aim is to make profit. And even when you make profit, if you see an opportunity to make more money on that profit, you still want to invest in that opportunity to make more money. So the question now of building wealth in your life will just boil down to two things. Are you able to save each year? And when you save, where exactly do you put the money? When you save, where exactly do you put the money? Do you put it in a savings account, which is the easiest and safest for a lot of people? Instead of them to just keep that cash, they prefer to put it in a savings account. Now, a savings account, it's nice and it's safe, but it will never go away. Most times you don't even get a reasonable interest percentage. Most times it could be like 8%, 9%, most especially when you save with the traditional banks. There might not be price fluctuations when you're saving, because you're just keeping your money there, so you don't really expect price fluctuations. Most times your interest rate is fixed. Once they tell you it's 9% per annum or 10% per annum, that's what it is, because whatever they are doing with your money, they ensure that it is a safe investment in such a way that they are not supposed to have this issue of fluctuation like other investments, which could be stocks and treasury bills and the likes. Now, looking at your returns on savings, if you want to compare it, if you're trying to just use a traditional savings account, maybe you want to invest in the banks using UBA, for example, or Zenith, you know that the percentage that they're going to give you before you get a double digit as your percentage on interest. When I mean double digits, now I'm talking about 1 and 0, above 10% and above, that's double digits. Single digit interest is like 8%, 9%. So before you get double digits from 10% upward, it takes a lot. I don't know if traditional banks are doing that now, but I doubt. It takes a lot. Most times it's the fintech applications that are able to give you double digits on savings. Now, the next could be bonds or real estate. Most people say they get most of their retirement funds from investing in their homes and watching it increase in value, which could be real estate, or investing in bonds. Now, both of these options, they grow in line with inflation. And you know how the inflation is. It keeps fluctuating every year. This year it could be 20 something percent. The other year it would go as high as 30. Sometimes it could go down. And just like that, it keeps going up. But definitely there's a way to hedge this inflation. There's a way to work on your money so that you can hedge this inflation. That leads us to the third one, which is the stock market. So I'm trying to explain to you the different ways you can invest your money. Some persons will want to go with the savings option. Let me just put it in my bank account, provided I'm sure it's safe and it's not exposed to market fluctuations. Why some persons are going to just sit with it and like, let me just invest in bonds or real estate. Now, the third set of people will say they want to invest in the stock market. And the first thing that may come to your mind is, that's really scary. Investing in the stock market, it goes up and down. Before you know what's happening, everywhere is red. You start seeing minus 5%, minus 3%, minus. As soon as that's happening, the funds you have in that wallet, the funds you've invested in that your account, be it a physical broker, maybe you went to their office and all that, has started declining. So there are times where it can even decline by 10% or 20% in a short period. There are times it's going to decline like that. And then you're going to be wondering what exactly is happening. But it's a normal scenario, it happens all the time. But one thing you should know is that panic and that scary headlines that you see in the news, people start telling you investors are selling off, and you are then in a hurry to sell off. You don't even know why people are selling off, but you're just joining them to sell off. It doesn't make sense. Over time, the stock market grows with how fast the corporations grow. So when you see that sell-off, many people are panicking. The question you should ask yourself is, why did I buy that stock? Why did I invest in this company? If you don't have a strong why, as per why you're buying that particular stock you want to buy now, if you don't have a strong reason why you want to buy that stock, don't bother buying it. There's no point. Don't bother buying it. Because there'll be fluctuations in the market if you don't have a strong why. Does it mean that if you buy a stock today and in the next 1 month you notice it dropped by 3%, you will sell it off? That's not how it works. Stock market investing, you should be coming in here with a long-term perspective. It is not MMM, it is not FTX, it is not CBEX, it is not a get-rich-quick scheme. It does not happen overnight. Does it mean there are no times that the market favors us? There are times the market favors us. You could just invest today and before 3 weeks, you're seeing your portfolio going up. And you're like, wow, this thing is really fast. I didn't know it was like this. Sometimes it happens, but it is not all the time. So that's something you should note. It is not all the time. There are times that would happen. There are times it will not even happen. Now, what does it really mean to invest in the stock market? When you hear the word investing in the stock market, you've seen a lot of ads. Some of you probably came from TikTok. Some persons joined from Facebook. Some persons joined from Telegram. And you're wondering, what does it really mean to invest in the stock market? What is stock and what is the stock market? What does it mean to buy a stock? Why does the stock market go up and down? Now, it's interesting to note that all companies have owners. A small company started by a single individual may have only him or her as the single owner. The large corporations that have stock, that's those ones that trade, that their shares are traded by the general public, they have many owners. To simplify and organize the buying and selling of these shares by the general public, the companies use the stock markets. In fact, US government regulations requires that a company, once it reaches a certain number of owners, it must go public. Now, this is to allow its now large number of owners to be able to buy and sell their shares of the stock in the company more easily. Now, just think about it this way so that you don't get confused. Let's pretend that your sibling or a close friend is starting a small company. He or she is doing really well, but they need more capital to expand. Or use yourself as a case scenario. You decided to start a business. And now, your business has grown to the extent that you want to expand. Probably you have more orders, but you're not able to fulfill those orders because you need more money to expand your business so that you can meet expectations. Now that your friend asks you to become part owner of his business by investing some of your savings, and then you agree, I'll take it back again. Think about it this way. Your sibling or a close friend is starting a small company. He or she is doing really well already, but needs more capital to expand. Now, he or she asks you to become a part owner in this business by investing some of your savings. You agree. Would you try to sell your ownership in the company just a few days later? No, you will not want to do that because you believe in your friend, that your friend has been doing this business. You will want to wait to see the profit he or she will make. Most likely not, you will not want to sell your shares in that company in a few days. It should be the same thing when you decide to buy a company's stock. The only real difference is that your siblings or your friend's company is a private company with just 2 shareholders, whereas there are many more owners in a public company with shares in the stock market. Without a saving faith in the future, no one would even bother to invest at all. To be an investor, you must be a believer in a better tomorrow. That's what Benjamin Graham says. You must be a believer in a better tomorrow. So investing in stock is like buying a piece of the company. You're simply buying a piece of a particular organization. That is what it means to invest in stocks. I've used a scenario of your friend as an example. Your friend wants to expand her business and decides to call you and tell you that I need you to participate. Can you just add funds? At the end of the day, we are going to split the profit. It's similar to what you do in the stock market. Most especially when a company decides to go public, like what Sterling Holdings is doing. When they decide to go public and they tell you they want you to invest in their company through their initial public offer, they need more funds to expand. They need more funds to do their business, and in turn, they pay you part of their profit. When they have this share price increase, of course, if it's a company that pays dividends, you get paid dividends. The next I'm going to be looking at is the 7 golden rules when it comes to investing. Now, being successful at anything requires following a set of rules. Even personal life, if you want to be successful, you have to follow a set of rules. If you're applying for a job, you first have to read through the job description to be sure at least you meet 50 to 70% of the job requirements before you even apply. That's when you stand a chance. That's when you stand a chance to even be called for an interview. So being successful at anything requires that you follow a set of rules. Good rules are the accumulation of decades of wisdom that are summed up into the few components that really matter. Investing in the stock market is not different, except that when you succeed in investing, you make money. You make a lot of money. Each successful fund manager's style was slightly different, but if you study each of them carefully, you will start to see significant patterns. Look at the likes of Warren Buffett, Peter Lynch, Walter Schloss. You see those set of people. They had rules, they had patterns that they follow. So without talking too much, let's just look at the 7 golden rules. When it comes to successful investing, let's look at the rules you should follow. Rule 1, think long term. That's the first rule. Think long term. Don't come into the stock market with a short-term perspective. First rule, think long term. Trying to time the stock market or risking it all to double your money in a year is at best speculating, is at worst gambling. It's just like Bet Naija. I've been seeing somewhere, I don't know if it's TikTok I saw that, where somebody was saying that this stock market looks like Bet Naija that wore suits. But it is not about, the stock market does not even look like that. It's because of the mindset that person came with. It's not similar to Bet Naija where you come and start thinking you want to play too short odds or something. It's not what happens there. If you come with that perspective, you will lose a lot of funds. It's not a get-rich-quick scheme. Rule number 1, please think long-term. Those people that are able to successfully navigate the stock market, they are not speculators or gamblers. They are investors. And investors know that they can beat the market because they think differently. They think smarter. They think long-term. If an investor learns to think long-term and can see beyond the daily and quarterly noise, you can gain a real upper hand. Warren Buffett says that you should only buy something that you'll be perfectly happy to hold if the market shuts down for 10 years. That's Warren Buffett, one of the best investors of our time. Don't just wake up one morning and decide to buy a stock because you saw a post that said if you had invested 3 months ago in this stock, you would have made 100%. That is not the time to go and buy that particular stock. It has moved already. Why are you going to buy it? It has moved. What you should be more concerned is that, okay, we have heard you. You said if we have invested 6 months ago or 3 months ago, this is what would have happened. Which one should we buy now? Are there recommendations for the now? That should be your concern. Not jumping to go and buy a stock that somebody has already posted that it has done 100%. It's now you want to go and buy. Who does that? Why are you buying at the top? Even if you tell me I want to buy high and buy higher, I want to buy high and sell higher. How do they put it? Yes, I want to buy high and sell higher. Are you very good at technical analysis? Have you done your fundamental analysis on that company? Are you sure that at the current price you're buying, it will still move up? Are you sure? Do you have strong basis for that? It's not every stock you see because they tell you the stock is selling for 2 naira, you jump in. Because it is selling for 10 naira, you jump in. Because it is selling for 5 naira, you move in. It's very cheap. It's just selling for 5 naira. Let me buy 1,000 units. Question 1. Why are you even buying the stock? Why did you buy it? It's because it's selling for 1,000. I was talking to somebody in the Investors Hub, our closed investment community. I was talking to the person. I was like, can I see your portfolio? That's what I mean is I want to see the number of stocks you have. The person showed me everything. There were some I recommended, there were some the person bought. It was a total of 8. And I was like, why do you have 8 stocks? Said that there are some that he saw, he felt like buying. Then there were some, because I know I did not recommend 8 stocks for you to buy. And there were some that he just saw somebody made a post and decided to buy. What do you mean by you felt like buying and somebody made a post and you decided to buy? You don't buy stocks like that. Rule number 2, good companies make good investments. Now, you need to understand that investing is not like placing a bet. I would say it again, it's not like placing a bet. It's not even like trying to predict which stock you think will go up the most. Fundamental investing is buying a tangible piece of a business or a share of that business. And your investment portfolio, which is the collection of all the different shares you own, is only as good as the sum of the companies in that portfolio. If you buy shares of high quality companies at reasonable prices, you will end up with high quality portfolio with less risk. It is as simple as that. Good companies are those ones that have a unique advantage that others cannot copy. Have you ever sat down to ask yourself, why is it that when I get to a shop, if I ask for soft drinks and I mention Coca-Cola, there's every likelihood that you will find Coca-Cola in that store. But if you call another brand of drink, they may or may not have it. Have you asked yourself that question before? It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's still by Warren Buffett. Rule number 3, buy with a margin of safety. I hope you're taking this down because the class is in progress already. Buy with a margin of safety. One of the reasons is because margin of safety is formed when one buys an investment at less than its value while using conservative assumptions. Now, the idea of margin of safety is that you want to buy a business at a price that is low enough that your assessment could be completely wrong and you wouldn't lose much. Rule number 4, do your own homework and own what you know. Do your own research. Own what you know. Don't sleep and wake up and you hear that the market is open from 10:30 a.m. You just log into your app and look. You finish looking at all of them. I just feel like buying Cadbury. I just feel like buying. You don't feel like. Do your own research. Own what you know. Don't just buy anything you feel like buying. It does not work like that. It does not work like that. There is no substitute for your own work. Even if I would let you know the name of a site that you can get recommendations for stock, but that does not mean you should not do your own work. They don't know it all. They are only doing their own homework. Buying a stock because a particular site recommended it, or because your uncle recommended it, or because the stock chart looks good is a sure way to lose money. Successful investors know what they own. They buy stocks of companies and products they believe in. Successful investors go the extra mile to analyze the financials of the company to make sure they are not missing anything. The last live class we had like this, I took my time to analyze the company's financial statements live. So it's important that you go the extra mile to analyze the financials of the company to make sure you're not missing anything. While you're working on your technical analysis where you're looking at the charts and other indicators, you should also be able to do your fundamental analysis. Remember, most of the extraordinary gains made in the stock market comes after a stock is punished or after it has already risen a lot. But you're not going to have the conviction to stick with it unless you really know the company. Peter Lynch says you have to know what you own, and why you own it. And if you can't hold a stock for a long time, there's no point holding it for 15 minutes. There's no point holding it for 10 minutes. Rule number 5, don't follow the crowd. Stay calm and be reasonable. Most times, a buyer's decision is usually heavily influenced by those persons around him. Buy when others are buying, sell when others are selling. You just see everybody is buying insurance companies, you jump in, you start buying insurance. You're probably buying insurance when other people are selling insurance. That's when you are buying. You go to the market and you look at your app. It's those stocks that are currently in green that you go and buy. Stocks that are in green that it is most likely that people are selling. Is that one you will go and buy? It's in green. Most times people are not even ready to give out that stocks to you. Is that one you will go and buy? You will leave that part of it showing red. No, you don't want to buy that one. No, the price is falling. What you don't understand is that if a price is going down, is that not the time you're supposed to buy it? That is if you understand the company. Is that not when you're supposed to buy it? Don't follow the crowd. The best investors are those ones that can fight this urge and remain calm through a storm. Be fearful when others are greedy, and be greedy when others are fearful. If you trade crypto here, you will understand. Warren Buffett has already explained it to us. We have to be fearful when other people are greedy, and be greedy when they are fearful. Right now in the stock markets, it's a bit unstable. Prices of most companies are going down. But this is the time to pick a position. This is the time to position yourself with strong companies. This is not the time to panic. But you only panic when you have gone to buy a stock from the top, because now that it is dumping, it's probably dumping on you. So you're looking at your portfolio and you're like, oh my God, I can't deal with this. Is this how it works? In the first place, you're not even supposed to be looking at your portfolio every day, meaning you were not given proper orientation. You're not even supposed to be looking at your portfolio every day. Rule number 6, please don't put all your eggs in one basket. Don't put all your eggs in one basket. What do I mean? If you are to buy a stock today, say you want to buy 3, don't log into an app or go to your broker in his office and tell the person, and they say, what stock do you want to buy? You say, I want to buy UBA, I want to buy Fidelity, and I want to buy Zenith Bank. You don't buy banking sectors all at once. Pick one. That's how you buy it. Don't put all your eggs in one basket. You pick one. If you're buying banking sector, just pick a bank. You can pick UBA. Just pick one. One is enough. Pick a bank that has strong fundamentals. Pick a bank that you've done your technical analysis on. When you pick the banking sector, then you can go over to the hospitality sector. You can decide to pick Transcorp or you pick Ikeja Hotel. Either of them, you can decide to pick them. Or you look out for other hospitality sectors, those stocks that are in hospitality sector. The same thing, you can go into beverage. Cadbury is there. Dank Sugar and the likes. So don't just put yourself in one box. Someone looks at your portfolio and the only stocks you have are banking sectors. So if something happens to the banking sectors and their share price begins to go down, probably based on news or something else, you find out that your whole portfolio is red. But when you have different sectors, you eventually have a balanced portfolio. All of them will not become red at the same time because they are not the same sector. Macro events might decide to favor a particular sector or may not favor the other sector. Inflation can decide to favor a sector against another sector. So those are the things you should look at. Don't just go ahead and just start buying things that you don't even understand. Rule number 7, never stop learning. That's the most important rule. Learn more, keep learning. Join paid groups, join paid communities. Wherever you know you can get relevant knowledge as per whatever you are investing in. It's very important you have the knowledge about what you're investing in. It's not a gamble. Don't just throw your money there. It's not a gamble. It's not a regular investment that will tell you you're gaining 30% in 1 month, 20% in 2 weeks. No, this is not how it works here. We think long term. Never stop learning. The fun thing about investing is that the markets are always different and companies are constantly changing. So don't stop learning about businesses. Don't stop learning from other investors. Don't stop learning from your own mistakes. Humility and an eagerness to learn are true traits that should be found in every investor. Now, I know you've been hearing me say that the market prices goes up and down. Sometimes your share price may fall, and you're wondering, but why do stock prices fluctuate so much? So that's the next thing we are looking at. Why? Why is it always going up and going down? You open your investment app today. Today you're seeing this particular one is saying minus 10%, and you're like, what? Why is it going down? Should I wait for it to go down before I buy? Or should I wait for it to move up so I know, okay, it's following an upward trend, this is the time for me to buy? No, that's not what you should do. The markets can decide to fluctuate in price, or a particular company's stock can decide to fluctuate in price based on general market sentiment. Sometimes it's just investor sentiment. They could just be greedy. They can decide to be fearful as well. So those are different things that could happen. So it could also be because of macro events, probably FX rates. It can also be inflation. It can also be government policies. So those are the different things that could make stock prices fluctuate. It can be the news, and this news could come from government policies. Now, whatever buyers and sellers are doing in the market, that's the investor sentiments. Now, whatever they are doing in the market has a way of affecting the share price. Even in a typical market, if you go to the market now and you have more demand for a particular product, what happens to that product? The price of the product, before you know what's happening, it goes up. It has happened to me before with a skincare brand. I wanted to buy this skincare product for my face. At one point, I wasn't seeing it. Like, why is this no longer available? Then the seller told me that the demand for it has been really much this period. The next time that skincare brand came to the market, when I went to buy, the price has gone up. So it's the same thing that happens. The price goes up when you have more demand. But when you have more supply, say you go to the market and you have so many people supplying yam, you will notice that you can price that yam effectively. Because you have many people, like, madam, if you don't sell, I move to the next person. I will get it at a better price. So that are the things you should look at. Understand the value of a business. If you don't understand the value of a business, you will not even know why you are investing in that particular business. You need to understand the value of that business. Now, the next thing, what makes a good business? Finding a good long-term business is not easy. What makes a good business? So you take a quick look at history and you see only a few companies survive over time. How do you then know if a company is a good business? Now let's take this scenario. A business that earns a high return on capital, or sometimes called return on equity, is always the best business. Now think of it as the amount that a business gives back to you each year as a shareholder. It's the amount they give back to you each year as a shareholder. Much like the law of gravity, Murphy's law under the law of economics, anytime a business like a candy shop earns exponentially high returns, forces will come in to reduce those returns. So if a candy shop is earning a 50% return on capital like a magnet, this is certainly going to attract more people to open candy shops, charge lower prices, advertise more, and eventually those returns will be reduced. If a company earns a return on capital above average, competition is going to come in. High returns on capital attracts competitors, and most high returns end up being whittled down to average over time, unless, however, the company has something unusually powerful that others cannot imitate. Now, this is what we call an economic moat. The best companies are the ones that provide high returns on capital, but are still able to protect and grow those returns through a unique protection that makes it difficult for competitors at the gates to come and take it away. So aside the fact that they earn high return on capital, they also have their economic moats. Bigger is not necessarily better when it comes to digging an economic moat. It's very easy to assume that a company with a high market share also has a sustainable competitive advantage. No. But how else would it have acquired such a big chunk of the market? Take, for instance, Coca-Cola. Now, there are types of moats that have proven to last over time. We have types of economic moats. By moat, what I mean by moat is that what makes this company have an edge over another company. This person sells drink, this other person sells drink. Why is it that people are always going to this person to buy this drink more than this other person? What is that unfair advantage this person has over the other person? That's what I refer to as the moat. Now, types of moats, we have the intangible assets. A company can have intangible assets like brands, patents, or regulatory licenses that allows it to sell products or services that can be matched by competitors. The next moat it can have is high switching cost. The product or services that a company sells may be hard for customers to give up, which creates customer switching costs that give the firm pricing power. It could be network effect. Maybe they benefit from network economies, which is very powerful. It says the more people you have on your platform or in your distribution system, the better the value for them. Then some of them have this low cost advantage. Some of them have location as their advantage, where they are located. Some of them have access to a unique asset which allows them to offer goods and services lower than the price of their competitors. So for location, there are some products you will almost find everywhere. There are some products you will almost find everywhere. There are some products you may not find everywhere. But there are some products you will almost find everywhere, like Coca-Cola. Take for instance Dangote cement. Dangote cement is a product that you almost find everywhere, because they are always moving. Most of the times they are always moving. You see their trucks all over the place. They try to get into the nooks and crannies of different locations. That's why even if you get to that place and you do not find another brand of cement, if you ask for Dangote, there is every likelihood that you will find that cement there. So when you're investing, you should also be looking at the economic moat of that particular organization. So from the explanation so far, you would see that investing is not just about coming into the market and buying stocks because they are on sale. When share prices decline, what should come to your mind is that this stock is on discount. You know Black Friday on Jumia. That's what should come to your mind. Stocks are on discount today. Which one is good to buy? It's not the one you open your app and you want to run away. You should be able to have the mind to stomach certain downturns. It happens. It's a normal thing that happens. That is why when you're investing, you think long term. Make sure your mind is 6 months. Your mind is 12 months. And do not invest with money you will need in the next 3 to 6 months. That's not the money you should use. Don't use your rent to invest. Don't invest with your school fees. Don't invest with your feeding money. Invest with spare cash. With 5,000 naira to 10,000 naira, you can start investing in the stock market. It's not that deep. With that little amount of capital, you can start investing. You can be doing it monthly. There are mutual funds you can even get into. Now, like I told you before we got to this point, I told you that I was going to give you the name of a site where you can check stock recommendations. They recommend stocks there every week for those persons that like recommendations like that. Different organizations, different investment firms are there. They recommend stocks every week. So this site is called ProShare. 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 So you can take it down. They recommend stocks every week. As at the last time I checked, which was yesterday, they recommend stocks every week. But that doesn't mean because they recommend a stock, you will not go and do your own research. Because you saw buy, you just go and buy. Then tomorrow when it starts reducing price or the share price start dropping, you start complaining. But it's this investment bank that said we should buy. How come the price keeps going down and going down? Please, that it was recommended does not mean you should not do your own research. Except you so trust the recommendation of probably the individual or the firm. Now, the essence of giving you this site is to just give you a direction. When you look at it, you know, okay, if they recommended Dangote cement for the week or Dangote sugar, you know what to look out for. And so, okay, let me go and take a deep research on Dangote sugar. What's really happening there? Is it really a buy? That's what you should do after. I'm not trying to say you should take everything hook, line, sinker. No, that's not what I'm saying. These are questions to also ask. Is the company good? Look at the return on equity for the past 5 years. Is it greater than 20%? Look at the gross margin. Look at the operating margin. The gross margin is supposed to be greater than 30%. The operating margin should be greater than 15%. And there should be stable earnings and return on equity throughout the years. The next one is the company growing? Look at it with a 5-year period. If you're looking at the company, look at it from 2020 to 2025. This information, you can get it from the site called investing.com. The next question is to ask yourself when you're researching, is the stock cheap? The price earning ratio should be below 15x, which is market average. Is the price earning ratio below 15x? Is the dividend yield above 3%? Is the price book ratio below 2x? Those are the questions you should ask yourself before investing. Go to their financial statements. You will find their financial statements even on investing.com. If you go to that site, you'll find the financial statements. If you go to NGX, you'll find the financial statements. All these are available on Google. You would search and see them. But the question becomes, most persons don't want to put in the work. They just want to get it all easy. Hey, can you just tell me what to buy? I don't want to go through that stress. I don't want to bother my head with all that. It's still important you bother your head with it because it is your money that you're buying a stock with. It's important you understand how to read a financial statement. It's important you know what a financial statement means. Because if you don't understand what a financial statement means, you won't even know if the company is making profit or not. You would not even know. You'll be looking at the statements. You don't understand what it means. I'll give you an example. If you want to check if a company is making profit or loss, look at the statement of profit or loss and other comprehensive income. That is going to tell you a lot about the company, if it's making profit or loss. If you want to check if a company is going into debt or it will not be able to cover its current debts, look at the statement of financial position. It's going to explain that to you. But most times, people don't want to do the work. They don't want to take their time. They don't even want to understand how this thing works. Statement of cash flow. It's going to tell you a lot about the cash in the organization and how they are generating the cash. Is it from operating activities? Where do they get most of their cash from? Is it from investing activities? Is it from financing activities? But nobody wants to listen to that. But it's important that you have those information. It's important that you do a research on them so that when you're buying a stock, you are able to own what you know. You know why you're buying that particular stock. You're not just buying it. You're not just getting it for the sake of getting that stock. You're not just getting it for the sake of getting that stock. Now I'm talking to those persons, particularly that have not invested before. Those persons that have not invested before, please don't invest blindly. Don't invest blindly. If you haven't invested before, please do not invest blindly. I would emphasize the importance of doing your own research. If you cannot join paid communities, it's fine. Just make sure you do your own research. Don't buy a stock that you don't know what's going on with it. Don't buy a stock because you checked an Instagram page and it looks like people are talking about it. Okay, currently now, I think Sterling Holdings, they are currently working on their public offer. I don't know if it's out already. I don't want to give you an information that I'm not 100% sure of. I don't know if it's out already. Now, some of you will go to the bank and go and buy from them. I'm trying to say it now because Someone did the same thing to me last year and was then reaching out to me this year and was asking me how are they going that the stock, the shares they bought from Fidelity last year up to now, they don't know where it is, they've not seen it. And I'm just going to tell you the truth. Before you went to buy it, you didn't tell me. I can't help you. I will tell you the truth. I can't help you. Because if you're going to the bank to buy a share, be sure to follow up with them. So you don't go to the bank and buy a shares and then come to meet me for follow-up. I always advise, if you want to buy shares, if you're buying it in the bank, please ask questions. When you get to the bank, ask questions. I'm buying these shares now. When would I see it in my portfolio? And how would I know it has reflected? Ask them questions. Ask them, where is your CSCS number? Your Central Security Clearing System. It's a unique number that you should have as an investor. Most times your investment app, they give it to you there. AfroInvest will give it to you there. I don't know much about Bamboo, but AfroInvest gives it to you there. You should have a CSCS number. So while you are preparing, as you're seeing initial public offer now, you're warming up to go to that bank, please ask them questions. Or better still, download an investment app and use it to buy whatever stock you want to buy, so that you can track the performance without having to run about to figure out how it works. It's important that you don't just buy a stock blindly. I know why I'm saying it over and over again, because up till now, that person that bought then, I don't know, but it has not reflected and she does not know how to track it. But I know with time she will figure it out. But I'm just telling you, just to avoid the delay, just do what is right. We have our investors hub. That's where I exactly research stocks by myself and I recommend it for our community members. This year, some of them have done with FTN Cocoa. Some of them bought it. That was in July. I told some of them to buy. Some of them bought it, and I intentionally told them it's a short-term stock. Short-term stock, we're talking about 1 month. So you're not supposed to hold it for long. So for short-term stock, of course, I know it is risky. So before I recommend it, I will tell you it's a short-term stock. So give or take 1 month period. Let's see how it goes. And it is not even for everybody. It's just for members of my investors hub. So those are the people I recommend those stocks for. Long-term stocks as well, I recommend it for them. Most of them are done over 30% on their investment. Some of them are done 40%. The other person that did 50% was trying to withdraw recently, which she has been able to do. So most of them had done different percentages over the year. Some of them last year, some of them this year. We have new people that joined us as well. They've done different percentages on their portfolio. Someone that bought Dangote Sugar, I think the early 2025, that was when he bought Dangote Sugar. I recommended a lot for them. Dangote Sugar, we bought Better Glass, a lot of them. So if you want to go and research how well they've performed, you can do the research yourself. And you see that most of them have given us so much returns. Better Glass was like the most interesting. I believe you must have seen Better Glass in different posts, probably Instagram or Facebook. We bought Better Glass in January. CWG, that's Computer Warehouse. It's a stock we also bought in the community. So if you're somebody that's looking for a community that recommends stocks for you, that guides you through the whole process, that tells you when to buy, when to sell, when to hold, should you accumulate, should you just sell it off right now, what should you do, is this for short term, is this for long term, someone that follows you up and tracks your whole process, well, it's advisable you join the Investors Hub. It's a paid community. Of course, I'm going to tell you that. It's a paid community. It's not for everybody. I've already explained so far what you should do if you want to do your investments on your own. Now, the investment apps I'm going to recommend, because this call ends in 13 minutes. The investment apps I'm going to recommend, you can use the Bamboo Investment app. You can use the Trove Investment app. You can also use the AfroInvest Investment app. Whichever one is more feasible for you, whichever one you can navigate quickly, make use of it. They are reliable brokers in Nigeria. even if most of them are affiliated to other brokers. But just say they are an investment platform. Okay, let's put it as an investment platform. So you can use them. I currently use the Trove app, but you can always use either of these recommendations. Even Yocha is fine. It depends on what your goals are, your investment goals are. But if you're somebody that is like, okay, you want to have a call with me on one-on-one basis, or you want to speak to me,